Yes.
Okay, great. Right. The first thing we're going to do is we're going to look at a research report made this week by Ed Yardini. And this is some very important correlations here that's super important when you're investing. Um, one happens to be the S&P and the bond yield. And there's basically an inverse correlation. Whenever interest rates go up, people are willing to pay less for stocks because basically there's an alternative. So that's what's happening now. We're basically at a point where interest rates have been going up exponentially. And let me get some charts out here. Okay, so there's a couple important things to note here. Okay, so the first thing is there's something called reversion to the mean. Okay, the S&P 500 is the most common index fund in America, index or group of stocks. And people pay different amounts for the S&P based on what's available at the time as alternative investments. And you can see over time, this is going back to 1935, way to 1935. You can see that the S&P has been trading as high as 22 price to earnings ratio and as low as 6. And right now, the PE of the S&P is around 18. And so the reason why this is so important is the stock market and everything in investing basically revolves around reversion to the mean. So the average PE for the stock market is 15, and over time. And you can see that the stock market basically goes up and down and eventually corrects towards that PE of 15. And right now, what's happening is the yields are going up the yields are going up and the bond yields are going up. And whenever that has happened in the past, the stock market has gone down. So for instance, in the 80s, when there was a yield of 26%, the S&P traded at a PE of 8 or 7. So that's why the first thing we look at every week is what the 10-year Treasury is trading at. You can see by this chart here that it's been going up a lot in the past couple of months. And that's totally affecting the stock market. And you have to keep that in mind because when you're investing, if you can get a secure investment, a good yield in a secure investment, a lot of people sell their stocks and get into something more secure. So that's the first thing to keep in mind. And right now, this is what everyone on TV is talking about, this yield. And they're going up for a couple of different reasons. One is the Fed is raising interest rates, and we have pretty a hot economy, too. The economy is doing pretty good. We have a good job market. And so that usually when that happens, you have higher interest rates. So let's look at some of our top things going on in the stock market. The Fed actually made a statement earlier this week that they're going to be holding rates high and maybe adjusting higher in the near future. So that was really bad because the stock market, there's that inverse correlation we're seeing there. If you raise the rates higher, the stock market, what you're willing to pay for stocks goes lower. So that's not good for the stock market. But we keep track of seasonality too here. So every year we map out the good months and the bad months of the stock market. You can see by the average stock market total returns that the last 3 months of the year are usually good, positive. And that's usually because We have earnings coming out in October, and we have a lot of pensions, a lot of things that need to be funded towards the end of the year. And we have the holidays. So we have the Thanksgiving holiday, the Christmas holiday, and New Year's. And that's why we have green in this part of the calendar, because people usually get excited around the holidays. And right now we just have a situation where the stock market is overbought. So just to review, the stock market could be, and stocks can trade at an overbought state. This is overbought. This is something called stochastics. We follow the slow stochastics, and it's indication of whether the stock market is overbought or oversold. So when it's oversold, there's a good indication that's the time to buy. And when it's overbought, all the buyers have exhausted themselves, and they're going to start going down. And you can see, based on this, that we're overbought and we're starting to go down. So that's a good way to time putting money into the market. If you have like a small amount to invest and you wanted to put it into a stock, you want to buy whenever the stochastics are low and it's at the bottom of a channel. So I think I explained this in a little chart here. It's worth it if I go down here. Okay, so here's whenever these line up, that's when you don't buy or you sell. And whenever you have a bottom of this channel hit the bottom and you have the low in the stochastics, that's when you'd have a tendency to buy or start accumulating. These are just things that I followed, so it works for me. Right now we have a very seasonal good time of the year, but we're overbought. So that means I usually color code the weeks ahead, just so we can have a understanding of what they're probably doing, the stock market. So it'll probably be going down until we're a point where we're sold. We do have catalysts of earnings coming out. So if we had some good tech earnings from Amazon, Microsoft, Apple, that could make the stock market rally, because they've been leading the market this year. Okay, so we always keep track of some things that could make the stock market go up or go down. The biggest thing that is affecting the market now is the interest rates. And the Fed has basically said they're going to hold rates steady. Tuesday he said that, or maybe need to raise rates a little bit more. So we have to wait for them to stop raising rates before we can get excited about the stock market again. So it's these 10-year and 2-year is up 6% and 1.5% this week. So, and the stock market is down 1%. So that follows our correlation. Whenever the rates go up, the stock market goes down. And we're kind of sensitive like that in the stock market these days. Let me see. So catalyst for the market to go up. We do have earnings coming out from big tech stocks in the next 2 weeks, and the rest of the S&P 500. So if those are better than expected, the stock market will go up. And we're at a good seasonally time of the year. But we are overbought, and the US dollar is strengthening, and that's bad for the stocks. Right now, we also keep track of the stocks above the 200-day moving average. And right now that we're losing momentum. So last week it was 25% above the 50-day moving average. Now it's 20. And we're not really getting better in the 200-day moving average. So we're losing momentum in the stock market. The stock market was doing really good. We're right at a crosshairs. You can see most of the stocks and indexes we're following, we try to make sense of it by drawing a line at the top where the top of these, the chart falls, and then the higher highs and the higher lows. And you can see that it's actually following this pattern. And we're at the bottom of that pattern right now. So let's look at, all right. So 90% of stocks follow the S&P 500. So that's why we're paying a lot of attention to this S&P 500. We can see two different possible patterns here. We're mapping up the higher highs, and so far, this is the next spot, if it's following our pattern from this whole year. But we do have this other pattern following. It's like a lower high, lower low, and we're right at a point where it could break down out of this and start going lower high, lower lows, like that, or we bounce back up to here. So this week in earnings that are going to be reported is going to tell us which way that goes. And if we go down this way, that's not that great because then we're in a downtrend for the stock market. But we've been in an uptrend all year long, which has been really good. Okay, let's see. Okay, so look at the major variables. So I keep track of the major variables affecting the stock market because every day we have news that comes out that says, oil is up today. What does that mean? How does that affect the stocks we're following? And so each one of these major things we're following has an effect on the stock market. So oil is one of the biggest input costs in making products because you have to deliver things, and that takes oil. You have to use oil for making plastics, and so it's a very important. Whenever it goes up, it's a very good chance that there's high demand for it, and whenever it is going down, there's a low demand, or they're producing more. So right now it's been going up. That's a sign of a good economy and economy around the world doing good. Inflation is 3.7% currently. So the biggest inflation problems right now are rent and housing. And everything else other than rent and housing is around 2% inflation, which isn't bad. And it's near the target of the Federal Reserve. The dollar index is unchanged this week. It's been going up, and that's bad for stocks that are doing business overseas. Because if you do business overseas, then when you repatriate money back into America, you get less money if the dollar is strong. So lately, the dollar has been strong, and we're going to have tech earnings this week, and each one of the tech stocks are going to say, there's headwinds. We had problems with foreign currency translation, and that reduced our earnings. So we're going to expect that in our reports this week. All right, fear and greed. Right now, the stock market is fearful. 2 weeks ago was extreme fear. So what you have to do is do the opposite of what everyone else is experiencing emotionally. Whenever people are extremely fearful, you want to buy. And when people are greedy, you want to sell or don't buy. Right now we're fearful, and this is the dollar index. You can see we've been going down in the dollar for years, like maybe 10 years. And all of a sudden we're starting to appreciate. The dollar is starting to go up. So that's not the good pattern. And if it keeps going up, there's going to be earnings problems for big companies. You see, the VIX has been in a downtrend for a while. That means people are getting less fearful. But all of a sudden, people are starting to buy protection and starting to be fearful about their positions. That could indicate people are preparing for something bad to happen. So right now, we're still at a complacent level of 20 in the VIX. But if it goes higher, then when it gets up to 30 or 50, then that's a panic time. So we always review this every week, the emotional makeup of the investor. And right now, we're at a fear state. We could get into a capitulation or despair if one of these one of these things happen or something we don't expect. Right now, we're mapping out a couple different major problems that could explode into something big. We have higher treasury rates, and we have the government spending a lot of money. And if the rates of the treasury goes up a lot, we might have a recession or some kind of major problem where the economy is not doing good. We have a Chinese real estate crisis, AI stock bubble, and we have consumer debt where people are not paying off their credit cards in bankruptcies. And right now, people work from home, so the commercial real estate market could go bad. So we have all these things going on. We have a war, 2 wars we're funding. So these are all, and on top of all that, we have expensive stocks. So like I said, we have a PE of 18 in the S&P or 19, and the average is 15. So that's a 20%, 20% before we're down to an average. Okay, so those are all things that could make the market sell off. But if you're a long-term investor, you just have to understand this is the worst time to sell. This is the best time to sell. To buy. This is the best time to buy. Whenever everyone is excited, that's the best time to sell or don't buy. All right. So this was the big news this week for the stock market. This Federal Reserve President Powell said that the inflation is still too high, and he's willing to raise rates or keep rates higher longer to bring it down. And that wasn't good, and the stock market went down, most likely because of that. And we saw our graph, so we know the inverse correlation of rates and what people are willing to pay for stocks. So we're going to keep our eyes on this every week now, because we see right now, what I did was I put an X next to every time that we had the same rates that we did in the past. So we had 5% 10 years in the year 2003, in the year 2000. And at those times we had a PE of 15 in the stock market. So that means if we're going to revert back to the times when, what the S&P traded for when we had a 10-year treasury yield at 5, then it'll trade at a PE of 15. And that's like a 25% correction from where we're at now. That's returning to the mean. So you have to expect that to happen, and don't get freaked out if you're a long-term investor. But this return to mean happens all the time. And we've had situations where we can go up a lot and down a lot and not really follow this, but eventually it goes back to an average. So just keep that in mind, and don't get overextended in this environment.
So,
all right.
So Greg, is this related to what I've heard described as like the cost of capital, or that if the safe return is higher, then there is the equities have to be returning, maybe more a greater return on investment because they're competing with that higher safe rate. Yeah.
Yes. So for a simple example, in 1981, you could have a 10-year that yielded 26%. Now, who would want to put money in a 3% yielding stock that has the potential of going down when you have a sure thing that yields 26%? So, and also whenever interest rates are low, like they were in 2020, people are naturally going to want to put money in the stocks so they can maybe get a 1% yield and some growth.
Yeah, and the company doesn't have to, be as profitable to compete with that low rate, right?
Right, and there's something called forward projected earnings. Like I don't know what it's really called, but the cost of you're paying a certain premium for future earnings, and whenever the interest rates are lower, then you pay more for that future earnings. When interest rates are higher, then you pay less for future earnings. And that's why whenever we look at PE ratios, and right now we've been saying all year that stocks with high PE ratios that aren't growing that fast are at risk because people aren't going to be paying as much, paying up for companies at a high PE ratio, because that goes down as the interest rates go up. So that's why we saw a lot of the high PE ratio stocks go down this year, in what people are willing to pay for them. So right now we actually have, if we look at the, you see, okay, we have a situation today. It just started yesterday with AT&T going up 10%. What's happening is, for the last, as this Treasury's been going up like this, as the Treasury's been going up, we've had people less and less willing to buy stocks with yield, because, if you can get a 5% yielding Treasury, which is 100% guaranteed, who would want to put money into 5% yielding stock? What's happening today is we had a lot of, and it's flipping today, we have a lot of the top gainers are the ones with the highest yield. And I think AT&T made a really great report. They said they're going to confirm and raise their estimates. And AT&T was in like this downtrend forever, and all of a sudden they say they're going to do good. So now people are starting to buy, dividend-paying stocks. Abbott Laboratories, almost every Philip Morris. These are all stocks that are conservative that pay dividends. And the ones that are doing the worst are the ones with the high PE ratios. And whenever this goes back to this, whenever the interest rates are going up, people pay less for growth stocks, because each of these stocks that are high PE ratios that are, the SolarEdge Enphase, SolarEdge had a bad earnings report, so all the solar companies are going down. But okay, so what we've been having this year is every day we have a fight between yielding stocks that are conservative and the aggressive stocks that are growth stocks. And today it's just flipped, where the yielding stocks are the top gainers. So, and until today, the tech stocks have led the way, and they've done the best. So right now, it all has to do with this 10-year and 2-year yields right now, it seems. So you see, so it looks like the way things are going, the way these X's fall, like the 5% yielding times in the past, there's a very good chance the S&P will correct to a 15 PE ratio. So we have to be ready for that. Okay, so part of what I do, this is the S&P right now. We're at 18. And you can see over time it varies how much people are willing to pay for, the S&P, and that's called the multiple. What are you willing to pay for earnings of a bunch of companies? And in 81, this is whenever interest rates were 26%. People were only willing to pay 6 times earnings for that. And in 2000, whenever there was a dot-com craze, people were willing to pay 25 times earnings. So what I do every week is I try to, not every week, but maybe once a month or once a quarter. Once a quarter, they come out with updated holdings for mutual funds. And one of my fun things I like to do is compare mutual fund holdings from year over year, and sometimes 2 years to 5 years ago, to see how they've changed and what they sold and what they bought. And there are some stocks that are actually consistent over the years that they never sell. Alphabet actually happens to be one of the ones that, a lot of these big mutual funds never sell. You can see Meta, they didn't sell. United Health, they didn't sell. Visa, MasterCard. But they added NVIDIA, Eli Lilly, Broadcom, and Costco. And this is Fidelity Magellan. I think it's one of the largest mutual funds. And they got rid of Apple, Amazon, Procter & Gamble, and Home Depot. Does anyone know why they might want to get rid of Apple and Amazon in Home Depot and Procter & Gamble? So this is last year versus this year. Okay, so I think, go ahead.
For Home Depot, with mortgage rates going up, I know the home builders are having a tough time, so I think there's going to be maybe some pullback there in terms of building materials.
Right. Home starts are going down, and the number of existing home sales is down to the lowest since 2008, when there was a crisis in that market. So I guess what this mutual fund company did was they saw interest rates starting to go up. And as soon as that happened, they knew the playbook was it's going to make houses less affordable. On the flip side of that, if people don't move out of their house and they're not going to a next house or buying a house, they got to take care of the house they're at now. Maybe do some home renovation because they can't get a new house. So it works both ways with that idea. Any other ideas why these other ones were sold out, and maybe why some of these ones were bought? Okay, so for Apple, it's kind of obvious. We've been saying this. This is one of my biggest holdings, so I follow it like really, really closely. Apple is super overvalued right now. It's hasn't been growing at all. It's been flat earnings year over year. Yet it's still going up, and it's still trading at a premium to the stock market. So there's basically, until they find a new product or a new category or a new way to grow, they're going to be like not growing. And that's what this mutual fund is all about, is for long-term growth. I believe that Apple is going to come up with some more services, like they might buy Netflix or something, and then every one of their billion users will be using Netflix, and that generates money, or they'll do something like that. But right now, they're like flat earnings, and that's why probably they got rid of Apple. And Amazon, it's super overpriced. That's the PE of like 100 or 70 or 100, and it's not growing as much as it used to. So they did replace it with NVIDIA, which has like all these AI chips that we're going to go over NVIDIA later on, because we've been following that pretty closely. They have new AI chips that people can't buy enough of. And Eli Lilly, they have 2 drugs in the pipeline, one for weight loss drug and another for Alzheimer's. They could be the best, both of them could be best-selling drugs of all time. And so they're currently scheduled to grow at 30% a year, Eli Lilly. So it's like a tech stock right now in growth rate, 30%. Broadcom, they're getting into AI chips, and they're moving from selling chips to doing services. So their potential of half of their money is going to be service-oriented. So they're turning into a different kind of company. And Costco, I know Matthew has been following this, as you know, he's a Costco person, and they make most of their money through membership sales. And so their fees for being a member is pretty consistent, 90%, 95% return ratio. So in an environment like this, it seems like that could be a consistent stock. So that kind of explains why they did those moves.
Yeah, I think cost on the other side is that they pretty much sell a lot of the things they at a fixed markup. You have to run the operations. And so they're also, I think, kind of push on their suppliers for pricing. So I think that people may be spending more there than with home goods going up, food going up. That may be good for Costco in terms of memberships and sales.
Right, right. Okay, so let's look at another mutual fund. This is JP Morgan US Tech Leaders. We haven't gone over this for a long time. They got rid of PayPal holdings, Twilio, Match Group, Analog Devices, Teradyne, and they added Meta, which is Facebook, Oracle, Amazon, Adobe, and Salesforce. And I was looking at this list. Any idea why you would have they would have gotten rid of some of these ones on the left and added the ones to the right? So for PayPal, PayPal has been super struggling to compete with some of the other payment processing. Right now they have, we use a MasterCard, have like 90% of worldwide transactions for purchasing things using credit, and they're not growing as fast as they used to. And Twilio, I don't know a whole lot about that. Match Group, the one problem I have with Match Group, they do online dating websites, but they have to turn over their customers. Once you're married, you're not going to want to pay for a membership, so they have to turn over the membership. So it's not as consistent business model as others. You see, I don't know anything about these two companies. So why would they buy Meta? Meta they were down a lot because of overspending. They spent a lot of money on the metaverse, which turned out to be, so far it turned out to be a flop. But they started cutting costs, so they're profitable again. So that might be the reason why they have 6% position. That's pretty big. And they increased their Alphabet percentage from 2.7. That's doubling their percentage. Probably because they were down. They were down to like $80, $90 a share earlier this year. So maybe they saw it as a long-term stock to buy and hold. And let me see. I don't really have anything to say about this. But anyways, it's good to see what mutual funds, and this is an ETF, change in their positions, just to see if there's a stock you can research that might be something you can add to your portfolio. These stocks here, they're pretty high priced. Each one of these is like a very high PE ratio and kind of outside of the realm of things that I would, or Warren Buffett would look at. So I try to kind of avoid the high PE ratio stocks to review. Okay, so I had an article, Netflix jumps another 15% as Wall Street applauds upside surprises. Okay, we've been following this stock. It's been very volatile. They've had a couple things wrong with the company. People have been sharing passwords, and they've had problems with competition with Disney and Google, YouTube, and so they also had this paid subscriber and then ad-funded subscriber. So it turns out that if you pay for the full subscription, they're actually raising the prices on that, which is good. And on top of that, the ad-supported model is doing good too. So those are the catalysts for it to continue growing. And I did I got this from E-Trade. I always like to do a divide the years of the future earnings. So if you divide this year by this year, this year by this year, you'll get percentages. So it seems like they're growing around 19% if you average those out. The PE ratio is 26. So our formula for seeing if it's fairly valued is dividing the PE ratio by the growth rate. So right now, it seems like it's 36% overvalued. So it's not very compelling right now for me, as a long-term investor, because you do have a lot of competition. You have Apple, you have Google, you have a lot of companies with a lot of money that they can compete with this. So, but they are the biggest streaming company around right now. Let's look at some of the statistics. Their forward PE is 26, and the profit margin is 13, and these all meet the criteria that we're looking for. So whenever something comes close like this, I like to look at it and say, this is super close to what I would want to buy, but we have to wait for it to be fair value before, I would want to start looking at it. And okay, so right now, I also looked at Morningstar's idea of, the fair value. They said it's basically, the fair value is 0.99, which is 1. That means they think it's fairly valued where it's at. And I looked at CFRA, and they say that Netflix is ahead of its peers with new revenue streams. They say they have an advantage against everyone else. They also don't have to worry about Hollywood strikes, and I think they might have gained some ground on the rest of the streaming world whenever they had some content and Hollywood was on strike. The fair value for CFRA is 357, so it's undervalued by 3%. So I like to look at these numbers right here whenever we look at earnings, the PE ratio that people have paid for it in the past. You can see that this was all over the map. People were paying 90, 60, 70 PE for 99. And now, this year, it's gotten as low as 16 PE, and the highest is 61. So it's becoming more reasonable PE ratio over time. So that's a good sign. In the revenue, we like to see it's going up in a straight line. Look at that. It's all going up. That's like the example of a really good growth stock. And return on equity, we like to see that getting better every year when it is. So it's getting, 38, 24. Whenever you have this combination, but it's overvalued, you just kind of put it in your bullpen, and whenever it sells off like 30%, then you start looking at it. So anyway, that's I had an next article about AT&T. This is one of the stocks we're following. AT&T has been in a downtrend for like months. Years. How long? Let's look at AT&T. Okay. So what we do is every week I map out the indexes that we're following, and I draw the trend lines. And I do that for all the stocks we're following too. So you can see that we're very predictable in most of these indexes we're following. Let's look at the AT&T. Okay, AT&T. There it is right here. It's been in a downtrend since April of this year. And just today, it's very well could be breaking out of that downtrend. Then we'd be going to a sideways pattern maybe. And this is an example of a stock that's paying like an 8% dividend. Mark, what is your reason that you like this stock so much, besides the dividend?
No, it's pretty much the dividend. It's a classic stock. I've held it as a dividend stock a long time, and at this price, there's no reason to sell it.
Oh, okay, that's good. It's a good reason. Okay, so they basically, what they said in this report was they're actually gaining some 468 new postpaid phone subscribers. That's great. We were afraid they were losing all their customers to T-Mobile, but they're also doing real good with their internet offerings. So they're actually offering 5G internet and regular internet through the lines. So they also said that they're projecting their future projections for earnings, company's profits will be better. So the one problem, every stock regardless of where it is. It has warts. Like Google has the warts of potential breakup of the company. AT&T, one of its biggest problems is they have to clean up these lead cables, maybe. So that could be up to $4 billion cost, and that lead cables from their traditional landlines. So that may or may not happen, and that could be why the stock is down a lot year to date. But they're still down 20% from this massive downtrend we see here. So for me, what I did was I looked at one more thing here, the growth projections. So if you divide these years by each other, they're growing 1.5% for the next 2 years, and after that, they're not growing at all. This is their annual earnings estimates. So I like to divide these and get 10%, for a growth stock. But for a stock that's something you buy and hold and just collect the dividend, you just don't want to see this earnings projections going down, because then they might cut their dividend. So right now I think it's not going down, so that's decent. We'll keep on following it. Okay, so we're also following Tesla here. Tesla has it's a unique company that actually we don't know all the products that it has to offer right now. Every day we come up with a different possible $500 billion addition to what they're selling. We know that they're doing AI. We know that they're making supercomputers. They're doing a charging network that could be similar in business model to an ExxonMobil. And of course, they're making cars. And what's happening, they just had their report, their stock report, and it's basically saying that they're selling their cars at a lower profit. They're reducing their prices for it, and they're trying to sell more of it. And that's so that other companies don't take their market share. But they're not as profitable as they used to be. So their margins and what they make per car is going down, and that's not good. And so I mapped out I divided these estimates for the years coming forward, and it seems like they're growing at 20%. And the PE ratio is 70, so that's like a super premium. So it's super dangerous. If this is all they're selling, they're 3 times overvalued. But the one wild card with this company is Elon Musk might just say, we're adding SpaceX to this company, or he'll say, we're making a new robot that replaces workers, and that's a whole new business.
Question.
Yes.
How do you compare this one with NVIDIA?
We're going to go through NVIDIA next, actually.
NVIDIA have very inflated compared to the PE of 70 here. NVIDIA have 102.
Yeah, I actually went over NVIDIA stock next. Let's go over that next. So right now this is super expensive. I like to buy stocks when they have a PE, like a PEG ratio of 1, or something like that. Let's look at this article on NVIDIA. This is very convenient because you just asked about NVIDIA. There was an article that came out that NVIDIA can't sell certain chips to China because of export restrictions. And so the stock went down because of that. And the one interesting thing about NVIDIA is they have an insatiable demand for this AI chips right now. And you can see year over year, this year to next year, they're growing at 300%. That is just like off the wall, amazing. But after that, it tails off to like 30% or something like 26% for the years after that. But we don't know if next year is going to be a 300% also. So whenever we're trying to figure out what the fair value of this is, it's really hard, because if it was 300, if they're growing at 300%, there was a huge demand. We don't know if that 300% is because the Chinese were pre-ordering, knowing that they'd have export restrictions. We have a lot of, if you have pre-orders, then that makes this quarter look really good, but next quarter it's going to be zero, growth. So that happens a lot in the chip business. That makes this really hard to understand. If it was growing 300% every year over year, then the PEG ratio would be 0.08. But it looks like their average PE ratio is around 26. So if it was 26, if their poor PE is 26, and they're estimated growing at like 50%, then their PEG ratio is 5. So it's really hard to gauge based on. But they're gonna tell us in this earnings report in about a month, if they still have this amazing amount of demand for their AI chips. And if we keep looking at this and eventually 24 to 25 goes to 300%, then the stock is going to go up a lot. But this is the first time I've ever seen like a 300% year over year, increase for a big company. So that's the answer to your question, Joe, is we don't know because the PE, look at the PE of NVIDIA is like 100 right now, but the forward PE is 26. That means, the earnings based on this year's earnings, it's 100, but next year's earning, which is $10, it's going to be 26. So based on what they say in their earnings call this year, they might guide to we're going to grow up another 300%, but we don't know that. So it's almost impossible to really value this. That's why it's kind of an unknown right now. Does that answer your question, Joe?
Yeah, we are focusing too much on the growth, but the growth in export to China might be blocked if China favor the domestic chips, right?
Yeah.
So I'm still wondering the growth rate and potential growth between Tesla and NVIDIA.
Yeah,
even that NVIDIA is so inflated in price.
Yeah, it's pretty inflated, but the thing is, whenever they come out with earnings, their PE shrinks like 1/4 of what it was because, this estimate they gave a couple months ago, that shrunk their PE from 100 to 26 because, of their projections. But Tesla, we're keeping track of, the forward estimates because we know they have like several major projects going on that might be like their own Tesla company. We have the automated robo taxis. That could be like $1 trillion industry. You could have supercomputer usage. That's another half a Tesla market cap. You have the charging network that could be as valuable as ExxonMobil. We don't know which of those are going to actually work out to actual products. So until that happens, we're just going to let some analysts tell us the earnings estimates. Right now, it looks like it's overvalued. But we're keeping track of these and trying to make sense of it. Does that make sense? All right. So I'm going to go over because there's a lot of new people here. I'm going to go over in general, how I pick growth stocks. I like following mutual funds. I like following Warren Buffett, and based on listening to what he says and what people say that study him, these are the formulas that I have for finding good stocks for buying and holding. Like 95% of what I have in my portfolio is like buy and hold. And I try to have, these, the highlighted things in every stock that I'm researching. And you can see we're doing these comparisons, for anything we're going to consider. anything that could be in addition to something we're following. We like to have total debt to be low if it's not a bank. We like to have return on equity greater than 12, profit margin greater than 12. Market cap has to be a big company because that's more predictable. And the PE has to be reasonable, and a growth rate we like to have greater than 10. And we like to have a PEG ratio around 1. And we like to have a high free cash flow. And the company has to have a competitive edge. You have to look out 20 years and say, is this going to be a viable company? Are they going to have a product in 20 years? And you got to have like a demand, like Warren Buffett bought Gillette company because he knew people in 20 years will be still shaving. So that's an example of, a predictable product, and highly transparent growth streams, and little or no debt. Okay, good management. Okay, so what I'm going to do right now, just real quick, go over the spreadsheet I hand out every month, every week. Basically, what this does is it allows you to do paper trading and predicting how much things are going to be worth years from now. So, for instance, we can put 100 shares. I'm going to enable editing. Okay, you can put your own numbers here, but what we're doing is we allow you to put your own numbers here for the number of shares do you want in your portfolio. And we use these columns here, a yield, total value, growth rate, and what that does is that tells us how much it's going to be worth at the end of this year, next year, and the year after. And I tabulate right here how much your whole portfolio is going to be worth, years from now. And it's really nice to see that because you can actually plan for some kind of, big expenses, or if you want a retirement, you pick whatever time you want to retire, how much do you want, and you kind of use these formulas. It's very simple, the formula. So for Google, we put 100 shares at $139 a share. It doesn't yield anything. So the total value of that 100 shares of Google is $13,900. And if it grows at 15% a year, then at the end of the year, it'll be worth $16,000. And then the year after that, it'll be worth $18,000 if it's still all these numbers are the same. And that's what's fun about what we do here is we keep track of the growth rates. And, if we see some problems, then we have to say, this growth rate is in jeopardy. But that's kind of what we do here. And I think that gives you a little bit of clarity whenever you're in kind of expectations. Whenever things go up and down, you can look at this and say, I'm holding this so I can have this much in 10 years. It's not so I want to sell out of it tomorrow. Any questions on the spreadsheet?
I thought we used to have a NOY stock.
Well, I'm not following that, as one of the things we're following. What's interesting right now is, there's a lot of the high-yielding stocks, REITs, and mortgage, REITs, like companies, they're basically selling off now. And if you don't have any yield part of your portfolio, like now will be the time to start looking at that. For instance, let's look at, what I'm saying is right now, you remember earlier this year, all the tech stocks were down, right? And I was saying it's time to start dollar costing, putting a little bit at a time into some of the major mutual fund like holdings, and that's how right now they already ran up, but the ones that are down a lot are the yielding stocks. Let's look at some of the stocks that are, let me see, Altria. This is an example of stock that's yielding like 10% right now. And of course, it has competition of the Treasury. Treasury is yielding 5%. So as the interest rates go up, as the Treasury yield goes up, the demand for this goes down, but interest rates aren't going to go up forever. So this is the time, if you don't have yield in your portfolio, this is the time to start putting in some of those pieces in the portfolio, small amount at a time. But NLY and that's an example of a stock that's it's selling off right now because of the higher interest rates, but it could be like a high yielding thing you dollar cost into. We don't know when interest rates are going to stop going up. Does that make sense? So I'm not actually tracking that, and these are just stocks that you can actually calculate things with. Maybe I'll add that for next time. Any other questions? All right. So let's see. Okay, let's go over some just rules of thumb for investing. When everyone else is greedy, you want to be fearful when others are greedy, and greedy when others are fearful. That's Warren Buffett. So whenever there's a fear-greed indicator, extreme fear, get ready to buy. When people are greedy, don't sell or don't buy. When buying stocks, you have to try to think of where they're going to be in 10 years. Let's look at, as the last thing we do today, let's look at some of the stocks we're following here and see where they're going to be. Is there going to be a steady demand for this stock in 10 years? Apple, they'll reinvent themselves. They'll have a mental telepathy device in 5 years. They're always going to be making something new and people buy it. Verizon, kind of hard. They have a lot of competition. I'm not sure. These are Warren Buffett, stocks Berkshire Hathaway holds. General Motors. This is a Warren Buffett company, but you know what? They have a intangible labor cost. So that could be a major problem for a holding like GM. I'm surprised Warren Buffett would buy that, see that they don't have control over a good portion of their costs. But there will be steady demand for cars in the future. AbbVie. This is an example of a stock that's the growth and dividend stock. So it's growing around 10%. They're always coming up with new drugs, and they're acquiring companies. So they're growth and dividend stock. Visa, they have a 80% market share of the world's transactions. I don't think that's going away. The only problem that they have could be government might come in and tell them they can't charge as much. That's what's happening recently. We see Amazon. They're pretty high PE ratio, and they might be broken up. So that could be a problem. Right now, there's antitrust problems with that company. All right. Those are some, I think I've exceeded my time. But thank you all for attending. If you have any questions that you want me to go, or things you want to go over for next time, let me know. I think I'm done for now. Have a good weekend.
Thank you.
Thank you, Greg.
Have a good weekend.
Okay.
Yeah, thanks.